at the deals. But the more important thing really is that for us also is that we don't work from a perspective of like, all the deals are coming to you and you're reacting. We are very top-down thesis driven in terms of, looking at which areas we think, let's say the system productivity is low. Now go in those areas and be very purposeful and thoughtful in terms of the types of deals that you want to attract. And that's, so it's a combination of all of those things.
So they've answered the question so well. I don't think I can add anything to it, but do you mind if I answer a question that you haven't asked?
Sure.
Which is like what I'm most excited about,
Okay.
because there is really good things happening. So I want to start at, Marty's told me not to be, I've got to be very positive today, right, Marty? So okay. So I'm pretty well documented, including myself and our entrepreneurs and all all VCs, is that from 2021 to 2025, we've all failed. And we've failed more and more. And the returns coming from VCs, 8, 10, 12% are a joke. If you have to wait 12 to 14 years to get a 10% per year, then just buy a house, okay? It's better than going through the grief of wondering if your investment's going to be okay. So we failed. And so we all have to do better. For a high risk category like this, we should be hitting 25, 30% plus to make people wait that long. Entrepreneurs, from the perspective of growth, epic fail. Everybody was like, yeah, I'm going to raise $100 million and we're going to buy Facebook ads. Well, they don't work anymore. So people need to find something else to be able to engage with their customers on. Actually, so Suzanne's going to hate me for this. So don't mistake my admiration for a strategy for being my admiration for a person. But he ran the greatest startup campaign of all time. He had 40,000 people knocking on doors for free. He had probably all of NYU as unofficial workers for him. And the incumbents in New York City were a bunch of klutzes who were sitting on their hands having dinners with a bunch of wealthy people. You're being judgy here, okay? It was one of the greatest startup campaigns of all time, and we have to learn from this in venture. Both venture people, we got to get our hands dirty. It's not about making a couple of introductions now. Private equity is venture capital. Incubation is venture capital. Venture capital is getting involved and actually helping companies grow. Startup entrepreneurs have to be able to embrace the community to find new tactics to be able to grow against other founders. There are really, really well documented great companies. So I'm so excited by this because I think whether it's crowdfunding, crowdsourcing, using the community, building the community, these types of moments are the moments where unbelievably brilliant VCs break through and incredible entrepreneurs break through, and they don't need a ton of money to be able to do it.
Brian, I completely agree with you. And what I mean by that is one of the things that we see, and if you think about venture today and the venture from the past, is lack of liquidity sucks, and not getting a return for 10 years doesn't feel good. So one of the things that we've built as we've architected our fund is really, we call it the 3x3. So we look for businesses that we feel are going to follow those different stages. Some that are going to be early stage, we're going to be able to look to have an exit or a liquidity event within 3 years. So that we're really starting to return capital. And so when we kind of start looking at that, we have a protein supplement business that went from 30 million, they'll do 200+ million in revenue next year, that we're going to look to sell for between 3 and 4x. That's going to have a chance to return our fund. So we look for some of those businesses that we catch at an inflection point that we can add value to through capital, through our network, not just making an introduction, but rolling our sleeves up to help support them. And then you look at the deals that have an opportunity as you layer them in to have the later stage exit. And I think that's really, really important. We have a large RIA that sits on top of our fund. On the public side, we're generating 16 to 22% with audited financials over 5+ years of returns. And I think that is, kind of look at that, you have to have a risk premium tied to it from a venture perspective. So the ability to create and have wins early, one, it feels better to the investors, but two, it also drives up IRR and it drives up the opportunity to do more and create a lot more velocity into what you're doing going forward.
Excellent. Dave, thoughts?
We have a challenge because our department exists on the premise that we partner with people who have not accomplished anything yet. I mean, many of the entrepreneurs that come to us are coming with an idea. So we go through a lengthy process of testing their conviction, which is a very difficult thing to measure, particularly when you're talking about somebody who's young. And in the protein supplement space, a lot of these people are just out of college. So we're testing their conviction. We're also testing their innovation. We're trying to and not that we have the foresight or the crystal ball, but we want to understand why they think they're ahead of the curve in the marketplace, because access to capital is pretty good for early stage, particularly consumer brands. And there's a lot of buzz around some of these buzzy words, and people can get money. But that doesn't necessarily imply that they have the third factor, which is market fit. And we want to make sure that they understand, what the hole is that they're trying to address and how they're planning to address it. So that's a lot of the deals that come to us that we're looking at, of course, on behalf of our clients, are just through having made good guesses, educated guesses about people and their willingness to go through, hell and high water to get to that capital raising moment. But the better source of deal flow for us, and again, we're not investing, we're on the service side, but the better source of deal flow for us is through the founder networks. And I think it's been alluded to a little bit up here that there is this neural network of familiarity amongst people who are starting similar ventures. And particularly in some of these smaller spaces where, Polsinelli is great, we wind up building long-term partnerships with people who have become successful entrepreneurs in the space. And then inevitably the early startup founders seek those people out and ask them, will you please join my advisory board or lend me this time, et cetera. And those people are getting those requests, at similar velocity of some of the deal flow that these guys are seeing, hundreds and hundreds of deals a month. And so when they make a decision to lend their time to one of these founders, and then they come to us and say, hey, so-and-so is about to raise, a seed round, or they're going to go through some structured debt financing. It takes a lot of the guesswork out for us. We're pretty good. Our success rate is pretty good, but I really think it's important to, as you find an investment that you've become fond of over time, to really build a personal relationship with the founder of the company that you invested in, because they'll probably open the door to people that they know are sort of past those preliminary stages and have de-risked the lack of conviction, lack of innovation, and lack of product market fit. So a little bit of the strategy for us.
So one of my challenges, and this is, I think it's interesting. You hear people say we've looked at hundreds of deals a month. And if you start thinking about, you kind of break down how many people are in a firm, it's really hard to look at 100 deals a month, hundreds of deals a month, to actually take a look at them versus just open in a spreadsheet. When we think about, we want to have our founders that take the time, that build a pitch deck, that come through our network. We want them to have a feeling of, hey, this is what this looks like. And if it's not a deal we're going to invest into, we're at least going to try to help and support them. And that's where that vetting process coming through our network has made a huge difference, because getting a spreadsheet or getting a PowerPoint, it's not really looking at hundreds of deals. We see access and we see other things, but to actually vet and spend time to understand the conviction, because even if it's not a deal that you're going to do, you can learn something from it. There could be a network that comes from it. And I think that's really where you get conviction with really, really good deals.
To clarify, I do have a comment. So the reason at some point, so the reason we are able to look at hundreds of deals, because we have about 50 sector leads who are looking at these hundreds of deals. It's not one or two persons. So that's the reason.
So I actually want to highlight, there's a lot of AI is a great technology. I mean, it's a bubble and a great technology at the same time. And the use of AI in the private market investing, being able to work with unstructured data in a good way is mind-blowing in many ways. So, I come from, my DNA is systematic public market equity investing. And when I came to the venture side, one of the first thing I wanted to do was that, hey, I want a systematic, repeatable process. And that, if I have that, and it's repeatable, reliable, then I can, then I have a sustainable edge. And so the things that we went through is that, we the GPs together have done 70 different deals over time in India. We basically peel the onion on each one of them to come up with a systematic, logical diagram that, hey, this is what the investment process looks like. But you can't really actuate that investment process easily in the private market because you don't have data like you have in the public markets. But now what's very interesting is that because we have the very systematic process, all the unstructured data which is coming in the form of decks, meetings, transcripts, multiple calls with the founders, you could actually take you can take the AI engine and be able to extract all that information and put it in consistent with your framework. And that's actually very beautiful because you can process through a lot of information. You can process this consistently, and it will highlight the things that, in other words, let's say if you haven't talked too much about regulatory risk, it will highlight to you that, hey, these are the topics that you haven't covered, and go on and cover those things. And so that's where I look at the use of Gen AI tools is actually helping us process a lot more than with a very small team.
So I just want to make a couple of comments. One geared towards, so when AI came out and started beating all the chess masters, it's actually produced more chess masters now than ever before because it exists, right? That's one thing. The second thing is, so there in the last 4 years, we've averaged about 40 IPOs of venture-backed companies, and there's 1,500 unicorns. So what's the timeline to go just through that, right? So when Alan Patrick came to us about 10, 12 years ago, and he had launched Greycroft, he says, I'm just going to buy companies that I can sell. Because I'm buying these ventures. It's going to be short duration holds. There's no way any of them will go IPO. Maybe a couple of them did. But I'm just going to, I know that I can, each one of these I can sell because they have a market. And I'm wondering if that dovetails with what you're doing, Brian, or if that's actually the strategy more VC should be doing.
Well, so firstly, we're in a totally different world. Like structure and systems and all those things are very important. But like, this is a world where you have to be an animal. Like every single minute of every day is like scraping to make sure that your deals, like we have to be more involved in our deals than we've ever been involved in before. And I don't mean reporting, I mean involved in actually helping those deals grow. So like in those times of Greycroft, when he was coming through, like seed was $100,000 a month and Series A was $200,000 a month. Today, seed is still $100,000 a month, but Series A is $700,000 a month. So you've got this whole death valley now between seed and Series A, which means if you're a seed investor, God bless you, waiting for your returns to come back. Number two, the returns back then were like 8 years or 9 years. Now the returns, like, I don't know if anybody heard the All-in-One or whatever podcast JCal does, but they're talking like 12 to 15 years for early stage investment. Like I'll be dead. Like there's no point in investing like that. That's why I'm saying is we cannot have the returns that we've gone for before. It's all got to mix in together about how we build them. Oh, sorry.
I just wanted to make a quick point here. So exit strategies is one of the key things going forward. We have about 5 companies that are going through IPO readiness at the moment in our portfolio companies. But we have about 20 companies we are actively encouraging them to sell themselves, either to a bigger player, especially when it comes to medical devices. There seems to be a ceiling. They only reach a certain point, and you need to have a bigger player to actually promote it further. So exit strategies is the key. That's where you're going to basically retain your money, grow your money, and really go for some of the big shots.
Great.
And the IPO market will come back. Like you think President Trump is going to leave in anything other than a blaze of glory? Like the economy will be brilliant whether it wants to or not.
And I'll also say that we just got back from Dallas 2 weeks ago. I don't know if you guys have been reading the press, but Texas is coming out with a stock exchange, 2027, and Texas Stock Exchange is here, and I think it's going to create a lot of competition into the market. In particular, I think it's going to create waves with NASDAQ. So, we are focused on businesses that we can transact and sell. But I do think there's going to be some opportunities of where businesses are going to be able to be more, it's going to be more cost effective for them to go IPO.
And also, there's also tokenization. And so, okay, tokenization has only really been used so far for the president to steal a lot of money. But like in the future, it's going to be an incredible funding model for people to be able to work with. It's just going to take time because a lot of entrepreneurs don't want to IPO anymore because actually it's not that great.
Yes, yeah, absolutely.
So I want to comment on the liquidity a little bit. So it's true that you have to make the investment in the right company and it needs to produce the right business and then be ready for an IPO. But you cannot miss the macro effect on it. India has been a booming IPO market. There's a reason why that is the case. Because the household portfolio there is going from something like 8% equity allocation to now it's at 12%, on its way to like 30, 40%. That's typically the case across most mature economies. And that is the new money which keeps coming into the market. That's what absorbs the new IPO supply. US, or for that matter, most other markets, mature markets, household allocations have already moved beyond moved to a very healthy levels. You have to go back to 1980s, early 80s, when the 401k plans first came about and the mutual fund acceptance came about. And that's when a lot of new money kept coming into the US stock market and you had a booming IPO market. So you cannot, you have to don't miss the macro forces which are there that's behind this, whether you're going to have a lot of liquidity events or not.
One of the things that we try to do very early on in our diligence of a business is we always try to talk to at least what we believe could be one of their buyers. We want to understand what the milestones are going to look like, what the timing looks like, and then what type of velocity needs to happen for them for that to occur. Secondarily, I do think that the secondary market is going to become pretty frothy with some of the, call it, overspending that's happened and people are looking to get their money out. I think there's actually going to be some good value of some businesses that we're going to be able to invest into. I think you're going to see a lot of focus in secondary funds and some opportunities there.
Yeah, such a great point because the current stock market is so high. The only way they can justify the revenue multiples is by buying more companies and they come through. The other thing about India, which is super interesting, is when you see India like 1970s America, where suddenly everybody wants a driver, everybody wants a cook in their house, everybody wants somebody to do their hair at home, and nobody wants to get their groceries anymore. It's really easy to be able to predict which markets are going to be the unicorns. So for me, like ghost kitchens in India is an obvious one because the brands are going to come under pressure through the convenience economy where everybody wants to have something delivered within 5 minutes. So I think I don't like be all about India, but India is just very, very easy to predict right now.
I also think the Middle East is very interesting. There's a lot of things happening there. There's a lot of money there, and there's a lot of growth happening. If you look at Riyadh today from where it was 10 years ago, if you look at the number of cranes that are being it's incredible what's happening, and the pure amount of money that's there is incredible. Some of their deals are just 10 years behind, so they're very excited about some of their home food delivery service businesses and some of those other things. So I think that's an area that people should look at as well.
Have you ever got money out of them? Like they play with me like I'm like wool. And they're a cat and they just do this. And they said, no, tell me more about your wife and your kids and your family. And I'm like, it's like 5 meetings. I'm dead already.
When it comes to international investments, when it comes to international investments, we do a lot more in Europe because it's easier to deal. The way of working is very similar to the, not exactly the same, but it's similar. And we're also looking at opportunities in other South Asian countries and Central Asia and Middle East. But there's a lot of competition in India, to be honest, already. And you need to know the culture and the society to benefit from the opportunity that is there.
So something I want to add to the thing that Brian is saying is that, you really need to pay attention to in the emerging. If you're going to go invest internationally, you got to think about the currency risk. You got to think about the capital controls, and you got to think about, how transparent the reporting is. And the currency risk, I think that the situation has changed. As a dollar investor, like myself as a dollar investor, I worry a lot more about the dollar's value now in relation to other currencies. And so, so that, and then if you look at, I look at what has happened with Indian rupee, like, if you look last 15, 20 years, it's 4% decline every year, roughly about that, which is a big deal because it compounds over time. But then you got to think about, prospective return over time, or sorry, the next 15 years. And what has changed is that the central bank in India has gone from an inflation target of 4% to 2% now, whereas what's happening, from 6% to 4%. And what's happening in US, on the other hand, is that, we are saying that we target 2%, but we are running at 3% and we are easing into it. So that just, changes your dynamic in terms of what you should expect from a currency picture. The second thing is the capital controls, and capital controls, I think, relate more to, what is the balance of payment situation in those countries. And for that matter, I think that most emerging countries right now are in the good spot. And then the third thing I would say is that in terms of the transparency, I was really surprised. India obviously has a lot of bureaucracy, but that bureaucracy sometimes actually works for you. And so one of the really interesting example is that every private company in India is supposed to file with Ministry of Company Affairs their annual statement, balance sheet, cash flow, shareholder ownership, director's report, all of that, and it's all public. I can't get that kind of a private company information in US. And so, it's a very transparent market in that way.
So I think
David to have a US vehicle for these investments.
there
right?
you go. Yeah.
We did some I had a client that was doing some interesting textile stuff. They were they had invested in some organic cotton farms in India, and then we were dealing with the regulatory hurdles of having China, where the clothes would be manufactured, recognize another country's products as actually being organic in a way that it could get into the organic factories in China. And then, of course, we had to figure out how to get it over here, and then tariffs. So I would be lying to you if I told you that I preferred international deals to US deals. I think for me, I like to know what's on the shelves of Walmart and Target. And if I can stay on top of that, then I'm doing pretty damn good in my space. But happy to help however I can, of course.
Yeah, I've got a couple audience questions. So the first one here.
I'd like to ask, I have looked out that all of you can identify a target market, potentially that target market. So you're going to allocate capital. You're going to allocate capital to that market. What value added do you bring? Because you were bringing up the opportunity, how you could help companies, etc. I sense that you have that ability based on what you're talking about. You're an advisory role, but the execution of the business model is key. If you can't execute a business model, you can have all the brilliant ideas that come up. Doesn't matter. Meaning you could throw money at it. Where are you bringing value there in the execution of the business model in the companies you're providing capital to?
Okay, cool. So first of all, I'm Irish American, so I buy cheap. Like that's what I'm good at. I buy very, very cheap at the beginning, and then we have warrants and options, which means I buy cheaper. And then we have incubation, which means I buy cheaper. And at the very end, private equity, which means I buy the cheapest. And so I'm a pretty mediocre venture capitalist. I think there's really smart people who know to analyze deals out there way better than me. I'm a great growth hacker, and my teams are great growth hackers. So we started out as a branding company more than anything else. We just worked on branding and building brand. And I think that's why I'm based in LA, because LA is the center of storytelling in the United States. So we started bringing storytelling into companies, and then the companies would be like, hey, man, we want to learn about personal brand. And we're like, okay, cool, we'll do personal brand too. And then we brought in more and more growth hackers to do outbound and conversion and closing and everything else. So we're slightly different because we're almost like a full service marketing agency who do it for free, disguised as a venture capitalist with all of the money from a family office.
So just a quick one on that. So we offer hardcore value creation. Just to give you some examples, there's a company in our portfolio to do digitization of mortgage workflow. And we were able to introduce them to head of Wells Fargo mortgages, head of actually ex-head of Chase, JP Morgan Chase mortgages. So this is where we create value, and they were able to connect with the right people, get the feedback quickly, and develop the relationship. And eventually, actually, kind of lost it. They did not buy it, but somebody else bought that particular product because of the feedback they got from Wells Fargo and Chase. Same thing goes with medical devices. Connectivity, knowing the right people in the big pharma is key to making money in medical devices and digitalization of the healthcare. We have people who are on the board of hospital networks. So that's where our real edge is. How do you create value for these companies?
So we're fortunate. We have 65 people behind the scenes that support us. We have in-house marketing, creative, legal, finance, accounting. So when we bring an onboard a portfolio company, we bring them into our ecosystem. We make them part of our family. And I think that's one of the unique things of having an RA that sits on top. We don't just write a check. We just invested in a wound care business called Mimics, which just got FDA approval on Friday. We are helping them with their go-to-market. My background in the medical device business, with their distribution channels, with their support from a manufacturing perspective, and actually rolling our sleeves up to work with them and support them and help make sure they have a strategy. So they're coming to our office this week to spend 2 days. And when we think about real value creation happens, we're not only able to do that, but we're able to get warrants for the efforts and the work that goes with that. And that goes a long way as far as actually how we double down and value with our funds too.
So our approach to that is that, first of all, you got to be picking the really good, passionate founders. They are the ones who are at the wheels. They're going to make things happen. We are there for a ride. We will open the doors whenever we can. And we are thoughtful in terms of where we invest because, we don't have, let's say, expertise in biotech. So, I can't really help that person there. But, our sectors are, fintech, healthcare, agritech, marketplaces, e-commerce, those types of things. And there we are able to help our companies because we have connections in the ecosystem, both in the private sector as in the government sectors. And in government sector, it's really important in a country like India, you gotta have connections there. And these are not like that, we have an unfair advantage. We're not saying that, break the rule or anything, that we just want to put the right people together that they can have that conversation and move forward, right? And then the other thing that we do is that we are very also thoughtful in terms of how we're creating our portfolios. We are looking to get, 25, 30 companies, and we want to be able to make sure that those companies can actually cross-sell to each other. So just an example, India has a big cooperative banking sector, which is similar to credit unions here. It's big. It's basically has 30% of the 30 to 40% of the population there. It's not as digitized. The big banks are digitized. This ones are not. So we have an investment where this company is building essentially the bank OS. That these are the different widgets which are put together